Lyft, the company just out with earnings, shares down nearly 4%. For more, let's bring in Dan Ives of Wedbush Securities, who has a buy rating, and Rohit Kulkarni of MKM Capital, who has a neutral rating. Dan Ives, I'll start with you first. Your reaction?
Yeah, my reaction, just the knee jerks off a bit. I mean, Uber obviously set high standards here. I continue to think it's a number in terms of EBITDA and ridership metrics that make us more and more bullish. We be buying into this weakness, and I continue to think probably the knee jerk is because profitability, in light of what Uber did, hoping they maybe would have moved that forward. That's why you're seeing the stock get hit like this.
So why doesn't that matter, though, to you?
It does. I just continue to think they're going to be conservative in terms of guidance, do not want to box themselves in just because of what Uber did. If I look at the metrics and the valuation, this, in my opinion, continues to be a top 3 name to play in tech, just given sentiment and risk reward.
Rohit, I assume you completely disagree with a hold rating and a target of 50.
Yes, as in I think I would say that heading into the print, the expectations were high. Lyft has always pulled forward the profitability hurdle. Uber followed it to them, and now we don't see that in today's print. As in whether we hear that in the call, that remains to be seen. And also in this print, I don't see any inflection points. We saw inflection points in Uber. We saw accelerating revenue growth. We saw more users being added. In Lyft, it's kind of continuation of the trend. What we saw: slowdown in revenue, lesser number of new users being added, and kind of slow improvement toward profitability. So there is just a continuation of trends, so we don't see anything change right now.
I'm surprised, Dan, frankly, that you would urge viewers to buy the stock on weakness without even hearing the call.
Yeah, I mean, it might be, because if I look at the metrics and I look at ultimately, the projections going forward and the work we've done in ride sharing, part of why we've been very bullish on Uber and Lyft in terms of ride sharing is our view right now, AB5, I believe, is an $8 to $10 overhang on Lyft, just to start off.
The California legislation.
The California legislation. So right off the bat, I continue that something that's ultimately not going to be as draconian as we expect. And when I look at the metrics here, the knee jerk down, but if I look, and I expect on the call as well, profitability, I think they'll hit ultimately a quarter to ahead expectations. Now it's a prove me story.
How do they do that? How do they get there?
I think fundamentally it's really marketing. If you look at what's happened on the driver side as well as on the consumer side, they're going to have to sort of decrease some of that, which I think that's a big focus. And ultimately, if you look in terms of peak ride share, where they're starting to gain, that's the key in terms of the rev per rider. And I think that continues to be the story going into the rest of this year.
You mean they need to spend less?
They need to spend less on sales and marketing.
Well, that's where the big spend has been.
But I think that's something as we get toward the end of the year, what they're getting on those dollars, that's going to continue to pay off. That's why we like in the second half of the year.